Hello and welcome to this video. In this video, I would like to give you a guided tour through the balance sheet of a company. For this video, I've planned the following. I would like to guide you through all major items of a typical balance sheet. Major items means that they are typically there and that they are typically large in comparison to other items. And I would like to show you the structure and the economic processes behind the balance sheet, so that you do not only see numbers in the balance sheet, but that you also see the economic processes behind it. This is the balance sheet of a typical industrial company, a very large one. So what do we see here? First of all, we see the headline that this is the balance sheet. As of 31st December 2019. This means that it is a particular point of time where all those items that we see here are counted in and valued. And it is exactly midnight of 31st December 2019. And we see that it is in millions of dollars. So what we see here is a very, very huge company. Further, we see that the balance sheet is split into two parts. The first part is the asset part. The asset part contains all assets. That means everything that the company owns. And the second part is the liabilities and equity side. Liabilities and equity indicates that this part is two-split. It is two-split exactly here into liabilities. And liabilities means lended money. Lended money says that it has to be paid back one day. And equity, that is also called shareholders' equity, which means that this is the money that was raised by the shareholders, by the owners. So it is shareholders' funds. What else can we see here in the balance sheet? We see that the balance sheet balances, and that's why it's called the balance sheet, because both sides are of identical size. Both sides sum up to the same sum. And the sum, of course, are called total assets and total liabilities and equity, just like the sides. Seeing a balance sheet for the first time, it is sometimes hard to get an overview of how the numbers interact and especially how they sum up. So I have tried to structure this balance sheet in a way that you already see. Let's have a look at these items: raw material, work in progress, and finished goods. All three items together are the inventory. So if you add up 1005, 2501 and 1795, it should be 59, sorry, it should be 5265. The same is true for these three: cash, accounts receivables, and inventory. These three should be added up to current assets. And the current assets and the non-current assets both give the total assets. The same is true here on the liabilities and equity side, where these items form the total equity, these items form the non-current liabilities, these items form the current liabilities, and all three add up to total liabilities and equity. Honestly speaking, not all balance sheets look like this. In practice, often the assets and the liabilities and equity side are shown below each other. Often the structure of adding up the numbers is different, depending a bit on the design, so this is not standardized at all. Why are there two sides that are completely identical? Well, each and every dollar that we can see in this balance sheet is counted twice or is shown twice. One time on the liability and equity side that says where the money comes from, and another time where the money is put. This might sound a bit curious to someone who has never seen a balance sheet before, but we see each and every euro twice. I would like to show how that works out. If we start up a new company, let's say a little limited, on 1st July 2019, and we have raised some own money, let's say $25,000. And we now want to run this company, then we have to prepare an opening balance sheet. We see it here. This time it's an opening balance sheet. And this one is not prepared at the year's end, but this one is prepared exactly on that day where the company is started. Of course, we have put this money into our company. So we have raised some 25,000 and I have put it into the company. And what did the company do with the money? They have put it into the cashier desk. So we see the same 25,000 euro on both sides of the balance sheet, where it comes from and where it is put. If we now assume that this company does not only want to hold cash in the cashier desk, probably they want to buy a notebook computer, what will happen next? Next, the company will take out a little money here and buy a notebook computer. So, since the notebook computer has to be shown under property, plant and equipment, since it is equipment, $1,000 for the computer will be deducted here, because in reality the money is going out of the cashier's desk too, and it will be put down here into property, plant and equipment. Okay. So, now that you have understood that we show each and every euro twice, we can go deeper into the structure of the balance sheet. Our balance sheet has 5 layers. On the asset side, we see the current assets and the non-current assets. And on the liabilities and equity side, also the liabilities are split into current liabilities and non-current liabilities. Current means that this money is, or these assets, is currently here, but in next to no time it will be gone. While non-current assets are fixed assets that are meant to stay longer, and non-current liabilities is long-term lended money, like long-term debt, something like that. It is meant to be lent for a longer term. But total equity will never be paid back. It's the shareholders' fund. And the shareholder will never get their money back. Probably they will get some dividend or something like that, but they will not get any payback until the company is liquidated. So since equity is not termed, it cannot be included into current or non-current parts. It has a layer on its own. If we now say that current assets and current liabilities are short-termed, what does that exactly mean? It means that these assets, current assets, are meant to stay shorter in the company than 1 year, while non-current assets are meant to stay longer than 1 year. And that's why they are also called fixed assets. The same is true on the liability side. The current liabilities are meant to be due in less than 1 year, and the non-current liabilities are meant to be due in more than 1 year. Okay, now we understand that the vertical layers here are termed layers. So it depends on the termedness of these items. Let's go more into detail and let's start with the current assets that are currently there, but probably next to no time they will be gone. I would like to start with this little tire here. Of course, if you want to build a car, you need some tires, and probably you have bought those tires at some tire manufacturer. And as soon as you have bought them, they will be held in some stock. In this stock, all the raw material will be held to produce the car. So the value of this raw material, not only of this tire, but of those seats, of this steering wheel, and all the other parts will be shown in raw material. As soon as those parts are built into the car on the assembly line, this is work in progress. And everything that is in progress will be shown here under work in progress. Of course, value is added because this guy here costs some money because he is earning some salary or whatsoever. So his salary will be added to that car. So we see value added throughout here. And if the car is now taken from the assembly line and put into a large stock, maybe we look at this car here, it is a finished good waiting to be sold. And the value of this car is shown under finished goods. All three items together will be the inventory. If we now sell this car, typically the car won't be paid in cash. Typically we will send out an invoice and we will have to wait for the money until it is paid. The money we are waiting for, so the sold cars that we have invoiced but not yet received the money, we show under accounts receivables. So we are waiting for this money to be paid sooner or later. And as soon as we receive the money, may it be in cash or may it be via money transfer from the bank or as a check or whatsoever, it is cash and cash equivalents. So cash and cash equivalents, this is cash, and a check and a banking account could be cash equivalent. This is the money that is held by the company. What can we do with the money later on? For example, we can buy some raw material, but typically we won't pay in cash. We will wait for the invoice. As soon as we receive an invoice, we have payables, so money that we have to pay. And we show those liabilities because this money will be due sooner or later. We show those liabilities under accounts payables. Of course, those accounts payables will vanish again as soon as we have paid. What we see here is a circle of money and material flowing through our company. All these things are short-termed because they are meant to stay in the company for a very short term. And all this is working. All these are processes that are working day long. So we call this working capital. Current assets and current liabilities are both called working capital. But attention, working capital is just a phrase for both, for current assets and current liabilities. But we can't measure this phrase. What we can measure is the so-called net working capital, that is current assets minus current liabilities. But we will come back to that later on. What else can we see in the balance sheet? Of course, the long-term, the fixed assets. And here, property, plant and equipment is probably the most important one. Property, all the land that we own, plant, the machinery, and equipment, everything like office supply or whatsoever, is shown here. Typically, this manufactory that we see here, or the robots, or the computer, are meant to stay in the company for longer than 1 year, so that's why we show it under property, plant and equipment. For smaller companies, normally this would be it. In large companies, we see a lot more under non-current assets. Often we see intangible assets. Intangible assets are non-physical assets. And what is non-physical assets? For example, licenses. And every one of us has some licenses because we have those license stickers on our computers. So we have a license to use Microsoft Windows or Microsoft Office. And since we can't touch Windows and we can't touch Office, this is an intangible asset that we paid some money for. In larger companies, we also see some items that come with group accounting. So for example, we have Volkswagen, and Volkswagen has some interest in other companies like daughter companies or just some interest. Just like in Bugatti and Lamborghini and Audi and so on and so forth. So with group accounting or even with holding interest in those companies, we see further items coming like equity method investment, which is typically the revalued book value of those companies held, and the goodwill, that is what the company paid more than the revalued book value. Since this goodwill is not covered by any values in the balance sheet, it is meant to be intangible. And the liabilities part is split into current liabilities and non-current liabilities. We already know the accounts payables. That is typically operating business, but we see three items here, here, and here. So non-current liabilities, again, are those that are meant to be due in more than 1 year. So this is long-term debt. And long-term debt can be typically split into bank debt, so money that is lent from a bank, and bond debt, money that is lent on security markets, bond markets. So a bond is a certificate about lending money. If you lend money to this company, you will receive such a certificate here, and you will receive some so-called coupons, those little items here. And for each and every of those coupons, you will receive some interest on certain dates, typically yearly or quarterly. At the end, you give back the large certificate and you receive your money back. As soon as long-term debt is coming into its last year, so if long-term debt is due in less than 1 year, it will be shown here under current maturities of long-term debt. The debt that is short-term in nature, even in the beginning, is shown here under loans and notes payables. I hope you liked the video. Thank you for listening and see you in the next video.